Day 8, valuation metrics. Price earnings ratio. So these are more valuation metrics. The PE ratio compares a company's current stock price to its earnings per share, giving investors a sense of how much they are paying for $1 of earnings, right? So, how we looking at earnings per share? The higher the earnings per share, the better. So, a $5 earning per share is means for every share I hold, I'm earning $5. Whereas a $1 earning per share, for every share I hold, I only earn $1. High PE ratio means it's overvalued. A low ratio is better. So you usually compare these within the industry. So like say for instance we have Apple and Boost Mobile, right? And say they both have a $5 earning per share. They both have the same thing. Both of the companies have good fundamentals as well. Like they both have better cash and debt and all those good things. But if Apple's PE ratio is say for instance a 5 and Boost Mobile is a 10, Apple would be undervalued, so we would buy Apple because that would be a better investment, and then we can ride it up to that 10 PE ratio. Then we look to take profits. If we're comparing an industry within that same industry, so that's pretty much that. Okay, price to book. Now I don't like to use price to book that much. I don't actually like to use traditional valuation metrics too much because they're outdated and the stock market as a whole has had a super high PE ratio. So overall, stocks are just made way overvalued. So if you even read books like The Intelligent Investor and things like that, most of the stocks don't even meet those requirements anymore for the most part. But it's still a good way to get a gauge on looking at valuation and things like that. But book value is the difference between the company's assets and liabilities. So their total assets versus their total liabilities. So a price to book of 1 suggests that it's at its book value, which means everything is exactly where it needs to be. A high price to book value means that we can see significant intangible value, strong brand patterns, or growth potential, right? So, and the low might indicate undervaluation or consider a company facing financial difficulties. So that's just good to look. So that's why, like, and this is you have to do your research to understand, But I'll just rather look at the chart and see what's going on with that. Price to sales ratio. The price to sales ratio measures a company's stock price relative to its revenue per share. It is particularly useful for valuing companies that are not profitable, as it's focusing on top line revenue than earnings. So usually, if a company isn't having good earnings yet, we look at like the price of sales. What is the sales ratios doing? Low price of sales obviously mean undervaluation, while high means overvaluation. We will compare these definitely within the industry, and ideal for assessing companies with little or no profit, as it looks at how much investors are willing to pay for every dollar of revenue. So that's good to look at. Now we want companies that are making earnings for sure. So we don't want no company that, unless it be a good trade. Maybe it could be a good trade, but I need a company that's 100% established because the most important thing when it comes to investing is safety. You want a lot of growth, but you want safety, and the only way you can get safety is a good company. If you're not making earnings, eventually something gotta happen. Either you go start making earnings or you go liquidate. So dividend yield. The dividend yield is the percentage return an investor receives based on a company's annual dividend payment. So we can quickly look at 2 dividend yields. Verizon being one of them. So Verizon has a dividend yield of 6.99%, base is 7%. So if we was to put $1 million in there, I love that number. So put $1 million in there. Why not? We would make $70,000 a year. So if we put $1 million in there, we would make $70,000 a year for not doing nothing. Not doing absolutely nothing, we make $70,000 a year. So that's basically replacing. Most people don't. I think most Americans. I don't even know if they make $100,000. Like the average, I don't even know if it's $100,000. So that would be a good return. Just to put $1 million in parking and not do anything, not have to wake up early on time, or have to worry about somebody screaming at you in your ear, none of that. So that's that, and then we could look at a company like Tesla, which we didn't see that had one, or we could look at Apple. Apple's dividend yield is 0.43%, so you're not even making $10,000 a year from Apple. You're only making $4,300 a year for $1 million invested. Now that's insane. You're only making $4,300 from their dividend. So that's because it's a growth company. Apple's a growth company, so they put all their money back into growth, whereas Verizon put all their money into paying people. So that's the difference between that. Go back and lock in. Obviously, a high dividend yield may indicate that the company is returning a significant portion of its earnings to investors. So you just gotta be careful with that. It's more mature company. So yeah, usually like your big company, like the Procter and Gamble's. If you don't know what Procter and Gamble is, that's a P&G on every toothpaste and all that y'all see. Yeah, those companies own them things. Low dividend yield could indicate a growth company for sure, and they put money back into the company rather than paying it to investors because they look at it as they're paying the investors with growth potential within the company, which usually 100% return is better than a 8% return. So it just depends on how you look at it. And then enterprise value and EV to EBITDA. We don't really use these like that, but like I said, if you want to use it, you can definitely do it. Like I said, I don't look at traditional ways of investing because, like I said, the chart shows you everything you need to know. As long as you look at the basics and make sure that the company is on a basic level is doing what it needs to do, that is the thing. But we can look at here like the low. Obviously, the EV to EBITDA ratio may indicate that the company is undervalued or that it is strong. So a lot of these metrics back here, all the way like to the PB, the P to S, all these things. All of these are just valuation metrics. But like I said, the market is changing, so that's why you have to compare industry to industry. You have to, but honestly, usually the better company for the most part would have a higher value. So then you want to start comparing it to the company. Was the company overvalued or undervalued compared to what it usually is? You have to do research when it comes to this because it's not traditional no more. You can't. It's not a set number like anything under 10. Then we do that, or anything under 20. Those set numbers are not a thing no more. So let's just keep that in mind. But that's everything, man. That's everything. Appreciate y'all for tuning in. We gonna see y'all in the next one for sure.